In today's video, we are going to discuss living benefits riders that can be attached to a whole life insurance policy. So what exactly is living benefits? Well, what living benefits riders provide with respect to life insurance policies is access to the death benefit, not the cash value, but the death benefit to help cover long-term care costs. If I have a need to go into a nursing home or I need home health care, what these riders provide is me having the ability to access some of that death benefit in advance to help cover those costs as they can be expensive. Now, with that said, there's riders that can be attached to whole life insurance policies that are free. There are pure long-term care insurance riders, which come at an added cost. And there's pros and cons to both. And what I'll say is, in my experience, just in working with different companies and seeing how different riders are positioned, one, there's a lot of different names and they all mean the same thing. For example, some companies will call a living benefits rider a living benefits rider, and then some companies will refer to it as a chronic illness rider. Some will call it an enhanced accelerated benefit rider. My point is, the first point, there's different names. But number two, all companies have different rules. All companies treat living benefits riders, long-term care riders differently, especially when we look at the long-term care rider, where when we attach it, in summary, what you'll find a lot of times is that it will restrict the flexibility of a whole life insurance policy. So if your goal is specifically cash value first and you're interested in attaching a long-term care rider, it might make sense. But a lot of times what happens is someone looks at a policy without a long-term care rider and then that same policy with the long-term care rider attached, and we see that there's a lack of flexibility. Maybe I'm forced to pay the base premium for a longer period of time or indefinitely, or the cash value is negatively impacted. Where a pure long-term care rider often makes sense, and we're going to go through both of these thoroughly in a minute, where a pure long-term care rider often makes sense is if someone is interested in life insurance first, they're purchasing a whole life insurance product for the death benefit. Perhaps they've got interest in the cash value, but it's not the primary objective. So what that design looks like is life insurance first, long-term care rider attached, and we've got the cash value growing as well. If someone says, cash value is what I want to maximize that cash value, be able to use it, and the death benefit is secondary, at least initially, you can attach a long-term care rider, but typically the response is, I don't know if I want that. A, I'll just move ahead with the free chronic illness rider, if it's free, which many times it is. Or B, I'll look at a standalone long-term care policy, which is designed purely for long-term care benefits, and I can get a bit more value out of that. So let's get into some details here. So to begin, we've got living benefits, and then we've got long-term care. I'm also going to discuss the terminal illness rider, but that'll take less than 30 seconds. So the living benefits rider, this is sometimes referred to as a chronic illness rider. And then every company has different terms. So you're going to see an example with Guardian. They refer to it as their EABR rider, which stands for Enhanced Accelerated Benefit Rider. And what this allows for is you can access a percentage of the death benefit, so not the cash value, but the death benefit, to help cover costs when this rider, a chronic illness rider, kicks in, when we would actually be able to access the death benefit or qualify for it, is if we are unable to perform 2 of the 7 ADLs. ADL stands for Acts of Daily Living. If you were to Google search this, you'll see them pop right up. A couple of examples of the ADLs are 1, being able to dress yourself, 2, being able to feed yourself, 3, bathe yourself. Things that we need to do every day. And if we have an injury or we're sick and we need home health care, it's usually a result of not being able to perform these on our own. We need help with that. So that's when we would qualify for this rider. Now, a lot of times with a living benefits rider, there's no cost to attach it. However, some companies will exercise a fee if we want to use the rider, if we want to be able to access the death benefit. But again, 0 cost up front. A lot of times we will attach that to a policy if one qualifies for it, because it does not negatively impact the performance on cash value or death benefit at all. There's literally 0 cost. However, if I do need it down the road, it's kind of a case where, hey, I'm glad I attached that because If it comes into play where I could use it and I'm glad I had it, yeah, let's use it, as opposed to not having it and looking back and saying, man, I wish I would have added that. Long-term care rider. So this is similar to a long-term care policy, a little bit different here, but same concept. And this does come at an added cost and provides, again, a long-term care benefit. What I've seen is with some companies, not all, but some companies, it can really restrict the flexibility. And what I mean when I say that is when we're working with someone who's interested in a whole life insurance policy for this, the cash value, often they like that flexibility. What I mean is if you said, hey, I want a policy where I can pay in $100,000 per year, but I'm not committed to $100,000 per year, perhaps I only want to pay a base premium of $10,000 per year, and then add the other 90 at my discretion via PUAs. Well, you can do that kind of stuff depending on the company and PUA flexibility rules, but you will see some restrictions here. As an example, there's times we'll attempt to model policies. Maybe someone wants to fund a policy at $100K per year for 5 to 10 years and then stop. But then by adding a long-term care rider, we see that they are forced to continue to pay the base premium as long as that contract requires. Where if it's a traditional policy, it'll be up to age 100. If it's a 10-pay policy, it'll be through the 10th year, 15-pay through the 15th year. And sometimes you'll see restrictions such as not being able to exercise a reduced paid up option, where some companies don't have those restrictions. So it can really lessen the flexibility with a lot of companies, not all of them. So it's, again, always good to ask specific questions if you're interested in it. But in short, a lot of times we will look at it and the reaction is, not a fit. I'll look at a separate standalone long-term care policy and focus on my whole life product for maximum cash value. Again, if cash value is your goal. So let's hit on these 3 items. First, we'll hit on terminal illness, just because this one's pretty simple. And it is something you will get with any life insurance policy. It's automatically attached. And here's how it works. If you're diagnosed with a terminal illness, and specifically given 24 months to live, 24 months or less, what happens is you are granted access to 80% of the death benefit to use for whatever you want. Now, it's an advance of the death benefit. So what I mean when I say advance of the death benefit is if your death benefit was $1 million at the time of being diagnosed with a terminal illness, then you can access up to $800,000 to help cover costs. But if you were to take that $800,000 and then pass, what would happen is you'd be left over with a net amount of the difference, $200,000, which would go to your beneficiary. But what it does is grant us access to the death benefit upfront, and it's automatic 80%. Chronic illness rider. So it is a percentage of the death benefit. If you're unable to perform 2 of the 7 acts of daily living, there's a percentage of the death benefit that you have access to. And this will depend on the company. It can also depend on your age. Let's look at an example here. So we're going to look at a policy that we've looked at in the past several videos, the 40-year-old male paying in $100,000 per year for 10 years, but starting the policy at age 40. That's what he's doing. So here we have the actual numbers, which we always like to talk about. Maximum cash value, baby. Here we go. 100K per year for 10 years. There's my net cash value. Just about breaking even year 5. This has a couple riders attached, which is why the break-even point's delayed. But we've got the cash value build up. His aim here was high cash value. Okay, so the chronic illness rider, which is our living benefits rider, here we go. So this is one company here, EABR, Enhanced Accelerated Benefit Rider. So what this is based on, firstly, is based on the tabular detail values, which assumes you make the premium payments forever. So we've got to dig into this further, I should say, get accurate numbers if our plan is to fund for a shorter period of time. However, let's take a look here. What do we see? We see total lien limit, which is the total amount you can access for either a terminal illness, automatic 80%, or for the chronic illness, if you can't perform 2 of those 7 ADLs. But let's go down here to qualifying event based on age. This is more realistic. So we've got 2 options here. Let's focus on everything to the right, which is based on the current assumptions, which is the company's basic dividend interest rate. We've got the guarantees on the left, but we're going to focus just on the dividend example in this case. So if we look at this, we've got qualifying event based on age, 55, 65, 75, 85. What's the likelihood of you needing to access either the terminal illness rider or chronic illness rider at age 55 compared to age 75? When are you more likely to need it? At 75. The older we grow, from a statistical standpoint, the likelihood of us being able to actually, or needing to access this money increases. So where I'm going with this is terminal illness is always 80% of whatever the total death benefit is. So if we go look at the total death benefit at 75 or 80, we'll see that the figures here are 80% of that net death benefit figure. Chronic illness, however, let's start at 55. It's much less. So what you'll see is that it's always a percentage, but it will increase over time, meaning the older you grow, and if you need to access money for chronic illness, as the likelihood increases of you needing that money, you'll see that the percentage gets closer and closer to 80%. In fact, at age 85, you'll see that they match each other. But it does not start out at the same 80%. So there are tables that show exactly what the percentages are. And again, different companies treat this differently. So this is one example for a 40-year-old individual with one company. But when we're looking at this, we do want to know what those tables are. If we've got a serious concern about this in this rider, this one's free to attach. But what we see is that it does gradually increase over time. So, good rider to be aware of. And to summarize, what it does is grant you access to a percentage of the death benefit. And as you grow older, that percentage increases, which is nice. And again, this rider is often free to add. Underwriting is required. So if we check it off on the application, which we usually do for companies that offer it, underwriting will review it. And in most cases, they'll attach it. We have had a couple cases over the years where someone does not qualify for it based on something the underwriter has seen in their medical history. But in over 95% of cases, when we attach it, it's approved for and we add it to the policy just because it's free and literally does not negatively impact performance at all. And I can access it down the road if I need it. Long-term care. So when it comes to a long-term care rider, this does come at an additional cost. We talked about the flexibility earlier, which depending on the company, it can restrict the flexibility specifically because we're always looking at custom designs with whole life insurance policies so someone can really use that policy to maximize the cash value and adjust payments as they want. We're often being very creative in that respect. And this can restrict that creativity, to explain it that way. So that's a big reason why it often does not make sense for a lot of people we work with. However, let's assume it's a case where it does make sense for you. How would it work? Well, you've got the cost, which is the actual premium that's added. Now we're going to look at an age 40 individual, which is someone very young to take out long-term care, so that will be a very low cost. But what are the benefits that we receive here? Well, if we look at the benefits, let's take a look at an illustration. This way we can get some visuals here. Here we go. So this was one of the illustrations you can see from our last video that includes the GIO option, guaranteed insurability option rider. We've got our waiver of premium, but then here we've got our long-term care rider. We've got all these terms, right? LTC pool, $416,000. Long-term care premium, inexpensive for this 40-year-old individual, $300 a year. But what does he actually get in this particular case? So here we see a chart that displays the guaranteed values. Basic LTC pool, $416,000. Maximum monthly benefit, $83.21. Minimum number of months, 50 months. Again, based on the guarantees. What am I looking at here? That was my question the first time I saw this, and many times after the first time. So what this displays here is if you qualify to use this long-term care rider, you go into a nursing home and you legitimately need to access this rider and you attach it to the policy in order to be able to cover these costs. What this is telling us is for a period of 50 months, you can draw a maximum monthly benefit of $8,321. Now, when we look at this, take that $8,321, multiply it by 50 months. What do you get? A 416 number. Now, it's slightly higher here. We see it 416.50, and the number in the illustration is 32. There's an $18 difference. What that tells me is the monthly benefit is $8,321 and a couple cents per month, right? Likely not a clean $8,321.00, but just about there, and that's typically what you'll see. Now, keep in mind that this is guaranteed here. If you've got a policy and dividends are being paid to the policy, you can also select a dividend option instead of paid up additions. You can sometimes select it to be long-term care additions. What that does is pump up the long-term care benefit as the years pass. So again, if we're interested in a policy just for, let's call it insurance, life insurance, if I die, money's paid to my beneficiaries. If I need long-term care, I have it as well. I'm bundling a life insurance product and a long-term care product together. And I've got cash value that accumulates over time. You can do that with the pure insurance approach. You can do it with the cash value approach as well. But again, when we look at the numbers, comparing with and without and taking into account all of the flexibility features, like with this company, if we want to add the long-term care edition, so if you said, hey, I want the dividend option, not to be paid up additions. I want it to be LTC additions because this company has exactly that. You can do that. But remember where I talked about the lack of flexibility? So if you do that, what happens is we cannot attach, I got to scroll up here. We cannot attach this, our 1-year term insurance rider. Which, specific to a Guardian policy, if you have a 1-year term insurance rider attached, then you can have a design where you can pay 10x your base premium in PUAs per year, which will maximize the cash value. So now if we go with the long-term care rider additions to have dividends beef up the long-term care benefit, now our PUA payment cannot be 10x our base premium. You'll see it's $9,090. I'll scroll up in a minute. Instead, it can only be 3x, which will really make the cash value look not attractive compared to what we've seen here already. So this is one example with one company about the lack of flexibility. And there's our 1-year term rider. We won't be able to use that. We could use a renewable term rider, which is a level term death benefit, but we cannot 10x the base premium then each year. We can do it in the first year, but aside from that, Guardian will not allow a higher number unless we went through medical underwriting. But my point is, there's a lot of rules when it comes to long-term care riders. And I'll also add, I'm not an expert when it comes to long-term care by any means. Our company focuses on whole life insurance policies that are set up for maximum cash value, short-term, long-term, maximum flexibility, helping people set them up, then use the policy, whether it's for loans and such, a lot like all of the other videos you'll see on our channel, both on the individual and business side. So when it comes to long-term care, yes, we can attach it, but just from all of my experience over the years and looking at how these long-term care riders function, when someone works with us and wants what I just described, maximum cash value, flexibility, all those benefits, and the optimal value, this will take away from that a little bit depending on the company. Sometimes it's more than a little, depending on the company and product we're looking at. But we can always look at it. You know, if it's me, how I like to approach these is show me what it looks like with the perfect high cash value policy compared to that exact same policy with the long-term care rider attached, and then show me the difference. What is my obligation? What do I give up in flexibility? What do I give up in cash value performance? How does the long-term care rider work? What does it look like? And this way we can see it up front, discuss it, and then you can make an educated decision. So in any event, I hope you enjoyed this video. And this is always a popular topic. If you have any questions, please reach out to us direct or leave a comment below. If it was helpful, please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.